Hey guys, this is the state of the market for March 17, 2016. Now, the market just closed, and the big event today was the FOMC meeting, in which the Fed decided not to raise rates, as most people had expected. Now, I stayed out of the market today because there's a small probability that they do raise rates, and in that case, what you can expect generally when interest rates are raised is that the stock market will take a tumble. So will gold and other commodities, and banks and bonds will probably go up a bit. Now, we didn't see that, and it's not that surprising now. It's not surprising as we got closer to today, but it is surprising because the last time the Fed raised rates was in December, and they stated that they would be raising rates 4 times in 2016. Now it's already the end of the third quarter, the first quarter here, so we're running out of time to raise rates for the first time. Now, if you go to the CME Group's website, you can see the probabilities of the Fed raising rates during the next FOMC meeting. So we've got a total of 6 more meetings in 2016. Now, for the Fed to actually meet its quota, its self-given quota of 4 rate raises, it's going to have to raise rates consecutively. So that's not looking like it's going to happen. Instead, what's probably going to happen are 2 rate raises, but we don't really know. So we want to use statistics. Now, the statistics that we get from here are usually pretty accurate because people are actually placing their bets on this stuff. So all you have to do is search for CME Group interest rates and count down to the FOMC, and you can get to the site. Now I'll show you how to use it. What you want to look at, first of all, is this number here, the probability of rate hike, 12%. So we're looking to April, and it looks like in April they're not going to be raising rates either. Now, if they do raise rates, the probability that those rates will go to 0.5 is 88.5%, and the probability that the rate will go to 0.75 is 11.5%. But this number is more important. Now, if we skip down to the meeting after that, we see the probability of the rate hike is now 41, and down to that, 46. Now, realize these probabilities are cumulative, so it means by July 27th, we have a 46% chance of a rate hike. That rate hike could occur at this time, in June, or in April. These are cumulative probabilities. So if you go all the way down to December, what we're seeing, surprisingly, is that the probability of one rate hike, of any rate hike, is 70%. So right now we have a 30% chance of no rate hike. And these probabilities changed drastically at the end of today. Prior to today, these were a lot higher. And actually, now we have the probability of negative rates, in other words, rate cuts, which is going to bring us to the situation we're seeing in Japan, where it costs money to keep your money in a bank. Now, that's true for big banks. It's not true for individual consumers. Not yet. But this is interesting. 70% chance of a rate hike this year. Contrast that with what the government said would happen, which was 4 rate hikes this year. Now let's look at the probabilities of these individual rate hikes. Since we have a 70% chance of a rate hike, we want to know where is that rate hike going to be. Now, out of that 70% chance, let's say the rate hike does occur, how many rate hikes are we going to see? Well, the largest probability, the plurality here, is 2 rate hikes. But we also have a high percentage of just 1 rate hike this year, and another high percentage of 3 rate hikes. But that 4 rate hike is looking very, very improbable. That's 5% of 70%. That's an extremely low probability. So if you had to take a guess from all this info, and this info changes pretty much every month because what the Fed does and the meeting after can give you some ideas as to what the Fed plans to do in the future. But right now it's looking like we do have a probability of a rate hike, and it's probably going to be 2 rate hikes this year. That's what people are expecting. All right. Now, why have these probabilities changed? Well, it's not surprising that the Fed didn't hike rates today, but the fact that they didn't just solidifies the idea that the economy is not as great as we think it is. We want to hike rates because we want to get back to positive interest rates. We're right now at near zero interest rates. We want to get back to positive interest rates. And if the Fed can do that, they have to do it within a context of a strong economy. Because when you raise rates, generally lots of the parts of the economy that people are putting money into will fall. For example, the stock market. All right. So I want to go ahead and take a look at some of the things that happened today in terms of stocks, actual stocks you can put money on. Now we're looking at the dailies here. I'm gonna start out with the SPY. Now, note that this is a daily chart, so we've got a candlestick for every 15 minutes. The Fed released its decision not to raise rates right here. You see down here, this is 2 p.m. So this big green candlestick is the first sign, and you can see that the shadow goes all the way up to 203. That's pretty much where it ended up at the end of the day. So when the Fed announced no rate hike, we saw stocks rally. Now that makes sense, of course, and that's what was expected, of course. My short positions are hurting. A lot of shorts are hurting because of this. The idea is that if rate hikes don't occur, you don't have the ability to make more money from bonds or from interest from banks. So you need to put your money somewhere else. And right now, the stock market is in bull mode. So that's where people are putting their money. This is all speculative. We don't know what's going to happen after this. I think it's going to fall again. But we should take a look at other factors as well. Let's look at the dollar. The dollar was hurt pretty hard by that announcement. And that's to be expected. If the interest rates rise, the dollar gets stronger. Now, interest rates holding, in this case, actually looks a lot like what would happen if interest rates were cut. It's surprising to see such a large fall in the dollar within a day based on the fact that nothing really changed. Remember, we didn't cut any interest rates. They're the same as before. So why would the dollar fall on no new news? It's just a confirmation that the dollar is going to continue where it is, but this is speculative. So by not raising rates, perhaps some of the proportion of the potential rate hike was already priced into the dollar. And once we saw the rate hike not occur, that portion that was priced in left the dollar, and now we're at more of a normal level. This fall in the dollar is going to help American exports, but it's going to hurt me because I live in Japan and it hurts my exchange rate. I don't like this very much at all. But that's where the dollar's headed. So some potential plays here. By the way, like I said, SPY I believe is going to fall. We are currently overbought. Let's take a look at SPY. Yeah, we're pretty much overbought. You see the stochastics here. We are overbought here. It's due for a correction. So I wouldn't play on the SPY unless you want to play a short position. But for the dollar, we are already out of that oversold region, so it could very well continue downward. I wouldn't recommend anyone play the dollar, the UUP outright. I would say go for a currency and go for a currency against the US dollar. So for example, buy yen or buy the euro. That would be a better play than playing the dollar flat. In addition, we saw bonds go up. Now this is a rather conflicting signal. If interest rates don't go up, the bonds shouldn't really go up. But bonds went up. Now, the reason is probably the fact that the Fed didn't raise interest rates is a signal that they realize there's a weakness in the economy. And when investors realize that, they bought into bonds because bonds are safer. They bring in safer returns. Stock market right now is very speculative. The reason the stock market is continually going up at the moment, even though it's at a it's at a relative low point compared to the past, it's going up because money's being pumped in. It's pure market manipulation. Bonds are less manipulated. Of course, central bank money goes into bonds first generally, but bonds also show the movement in the bond market typically precedes the movement in the stock market. So if you want to know what's going to happen in the future to the stock market, watch the bond market. If bonds go up, stocks will generally go down. So this is telling me that my bearish prediction on the market is probably right. Interest rates would have made that bearish move happen sooner, but it's still going to occur eventually. That correction has to occur because pretty much everything is overpriced in the stock market right now. Now, if you want to get into bonds, go for it. Bonds are safe. I'm going to show you later that, well, I'm going to show you now that there's a better choice in bonds at the moment, and that's gold. Here is the interest rate non-hike. See that huge candlestick that occurred with it? The reason gold goes up is because the dollar is going to go down in value. So you need to put your money into something that will appreciate as the dollar falls. And if you don't want to be speculative, and if you don't want to put your money in the stock market, commodities and bonds are your safest choices. Now, gold has had a great year. I think this is probably so far, year to date, the best it's been for probably decades. Gold is going way up. If you look at the monthlies, we are not overbought yet. So don't expect a bounce downward. And what you're looking at here looks kind of like a abandoned baby candlestick pattern, which generally predicts another upward trend in the future. Full disclosure, I am long on gold. So gold's looking pretty good, as is silver and all those other precious metals. Now, another commodity that's these days highly tied to the market is oil. Here we're looking at oil, and oil jumped not because of anything related to oil supply or demand, just because oil is a commodity. People who don't want to keep their money in dollars will put their money into commodities. Now you could see that gold moved up more significantly than did oil, but oil is still looked at as a pretty safe place to put money, especially now that it's on the rise. But don't expect that rise to last. That the recent rally in oil is not based on fundamentals, it's just short covering. So I expect to see oil fall again. When that's going to happen, I don't know, but it's going to happen this year. Supply is not declining, so don't think that oil has come back. Don't think that oil has already hit its bottom. It's not coming back yet. It will probably come back later in 2016, but this is not the time to be buying oil. What else do we want to look at? Let's look at volatility. So volatility is at a relative low. I'm long on volatility, speculative, through options. I never buy the VIX. It's a really bad ETF. It's an ETN, by the way. It's really bad to hold on to from a long position. But if you think that the market's going to be shaken up with bad news, it's good to have a speculative position in the VIX. Now, what happened when the interest rate hike was abandoned? Well, the VIX fell, volatility fell. So this basically is saying that the expectations of the market were confirmed by the Fed, and people kind of settled down. Now they feel like they know what's going on. Um, let's look at banks, which were probably the best to benefit from an interest rate hike. When interest rates rise, banks can charge more for their loans. So generally, XLF, which is the bank ETF, will move upward. Now, what happened was it moved downward, then it moved upward, then it trended sideways. People don't know what's going on here. Banks should have been more hurt by this, but the fact that a lot of money was pouring into the stock market after the announcement from the Fed means that bank stocks got bought as well. So the natural reaction should have been this red candlestick followed by a downward trend. But what happened was this candlestick followed by money being pumped into the stock market in general, which also bolstered the financial sector. So it's a little strange. I don't have any positions in banks. I probably won't unless I'm very confident that an interest rate hike is going to occur. And even then, the fundamentals actually didn't work out in December when the interest rate hike occurred. In December, I had positions on the financial sector, but the interest rate hike did not raise those positions. So I would stay away from bank stocks at the moment because we don't really know what's going to happen to these bank stocks when interest rate hikes do occur. Now, let's talk real quickly about why the Fed would want to raise rates or not raise rates. There are two main factors in a rate raise. Let's see, inflation. Let's see if we can get a chart of inflation. The official rule, and it became official in 2012, the official rule of the Fed is that when inflation is above 2%, they will raise rates because raising the rates drives inflation downward, and the Fed wants to keep inflation at around 2% or below 2%. Now, that's the official rule, but the strange thing is that, let's look at the last 12 months. The strange thing is that inflation, I guess CPI is going to be our measurement here. Okay, so inflation as per CPI, that's not right really. It's got to be a better chart. But back in December when the Fed did raise rates, inflation was not above 2%. So the official rule was not followed. Now, why would they raise rates? Why would they raise rates when inflation was not above that level? An easy answer is kind of a conspiracy, so take it as you will. But the idea is if you raise rates before the economy goes to shit, then when the economy does go to shit, you can cut rates more. So let's say rates are raised to 1%. Now when the economy goes to shit, within a year, the Fed can cut rates 4 times, and that'll cause money to flow into the stock market and bolster the stock market, which is what Japan has been trying to do. Now, the idea here is that if you raise rates, it makes people want to put money in the bank, and that's not good for the economy. You want people to spend money. If you cut rates, people want to take the money out of the bank and put it into the stock market, which helps the stock market, obviously. That's what Japan has done. Japan rate raise. Let's just look for it in Japanese. It's more interesting that way. Minus kinri. Kinri. And if you check the news, well, I guess check images. Well, what I saw was after Japan went into this minus the negative interest rates, instead of people pulling their money out of the banks, I guess we'll search for it in English. Negative interest rates. Japan. I don't know where I saw it, but okay. Safe sales, Japan. After, there we go. So actually, I saw it in Japanese, but you can see this is a news story that's popular enough to make it into these Japanese newspapers. But here's what happened. Instead of the Japanese citizens taking their money out of the banks and putting it into the stock market, they went and they bought safes. And they're just keeping their money at home instead of keeping it in the banks. So this negative interest rates policy really didn't help the stock market that much. It just drove money from banks into houses. So if you're a thief and you want to go find a good place to steal a lot of money, come to Japan. Now, that's what really happened, but still the theory, the economic theory, is that if you cut rates, money will flow into the stock market. So let's go back to this question, why did the Fed raise rates? Well, they raise rates so that they can cut them more in the future. The higher the rates are, the more times you can cut. Right now our rates are at 2.25, so you can only cut it once before we get to zero interest, and twice before we get to negative interest rates. But if we are able to raise it to 0.75, then we can cut it 4 times, therefore providing economic stimulus 4 times before getting into negative rates. Now another reason the Fed probably didn't want to cut rates, is because, increase rates, is because when you increase rates, employment increases, labor participation falls. Now, here's labor participation for the month. It has already fallen 3%. The economy is not doing so well. We got 63% in labor. This has fallen. Oh, we're looking at the yearly. Sorry. Yeah, it couldn't have fallen 3% in this year, but it's been falling. It's clearly been falling. So, if the government wants to raise rates, that's going to hurt employment. Unemployment's going to go up, and that's not so good because right now unemployment's not really that low. I mean, it is low for if you want to compare the US to, let's say, Spain or Greece, but still you don't want to do anything that'll push unemployment higher, especially right now when companies' earnings are on the decline. It's looking more and more like we are entering a recession. The government wants to avoid any catalyst that could push us deeper into a recession, and raising the interest rates probably would have done that. So that's it. Yeah, it's perhaps a conspiracy to say that the government wants to raise rates so that they can cut them more. It doesn't really make any sense. It's like adding so that you can subtract later. But that's probably what's happening, because there was really no reason to raise rates in December. And the fact that they're holding on rates shows that the Fed is probably pretty worried about the economy. That's it. If you enjoyed this type of video, State of the Market video, please let me know. Like this video and subscribe. Let me know in the comments section if this video was useful, and if so, in the future I could be doing a daily post-market recap for everyone interested. That's it.